Good morning, everyone. John Rosengard with Environmental Risk Communications in Oakland, California. Thanks for joining our webinar today on fair value measurement for environmental liabilities. I just wanted to start by giving you an elevator speech on fair value measurement. It covers a multidisciplinary topic, and I think it may be useful to just step back for a moment at a very high level. First of all, fair value measurement has, since 2006 for U.S.-based companies, been the preferred GAAP basis, generally accepted accounting principles basis, for pricing assets and liabilities. In other words, it's been around for quite some time. Why is it used? Why was it promulgated and issued? It's built on the reasoning that we have justification for why we've absorbed liabilities in the past. It's also based on common sense because it connects costs to market prices. And it also is something that it also is a price that potentially will be validated by a counterparty and not eventually someday over the longer term by an environmental regulator. Finally, we think this also enables a step change improvement in productivity, which we'll be trying to cover in our presentation here today. And most of all, I think there might be a strong business justification because it might be free when you factor in issues like an asset write-up in order to incorporate the ultimate closure costs. You look at accelerated and higher depreciation, deferred tax assets, and the other items that I've noted here. You may find that the cost benefit for deploying fair value measurement is actually reasonably attractive. How do you do it? First and foremost, you have to think like an outsider or think like the competition in valuing environmental liabilities. You have to have sort of an arm's length, third-hand perspective in doing the valuation. One step that I think is absolutely pivotal is changing a mindset where you think of cleanup projects and budgets as environmental liabilities. By breaking that pattern, we think fair value measurement can be readily adopted. So our outline for presentation today is I'll give you a little bit of the background about why we're here with fair value measurement, because it really does change the values of environmental liabilities that we use, budget for, how fast we work down the liabilities. So it's an important transition to go from using methods that we have deployed in the past to using fair value measurement, because it is the long-term direction that we all seem to be headed. Next, I want to cover mandatory and optional applications and the conditions that we see out there at ERCI in using fair value measurement for environmental liabilities. From there, we'll get into the calculations themselves and different options for how to deploy them and use them. And then I'll give you some examples of discrepancies where different methodologies, in sharp contrast to fair value measurement, generate dramatically different calculations for environmental liabilities. Again, part of the reason why we're here. I'll spend a little bit of time at the end of our presentation covering a justification and how to adopt fair value measurement. I've used this in other webinars, and again, I hope this is a useful update for this topic here this year. A little bit of background about me. I'm the founder and CEO of a company called Environmental Risk Communications. We started in 1994, so a little over 22 years of continuous operation. I'm the author of a software package called Defender, which really just forecasts environmental liabilities. That's all we know how to do well. So one of the things I want to point out to you is there are different types of environmental liabilities out there. That's a separate topic for a separate webinar. But I do want to point out that our software is meant to address the five major types of environmental liabilities that we see out there, all of which we've got listed, as well as some other activities that we're involved in. ERCI brings us in contact with our client base, which is normally corporate remediation teams and PRP groups. We also episodically have been helping support authorities that are technically public agencies and comply with a slightly different set of instructions and generally accepted accounting principles. We also back up the engineering, consulting, legal partners, and auditors that back them up, which in turn is part of the work that we've been doing. My more detailed bio is in my LinkedIn profile. Connect with me there if you'd like to learn more and see publications that I've been part of. Earlier in 2016, just like I did in 2001, I was a part of the ASTM work groups for E2137, which is the estimation standard, and E2173, which is the disclosure standard. If you'd like more information about those two ASTM standards, I really recommend you take a look at the ASTM.org website, get a copy of those standards, get copies of those, and see if they don't really improve how you can apply business principles to your environmental remediation or environmental liability portfolio. My educational background, I've got an MBA from Northwestern, a bachelor's in business from Georgetown, So who am I not? Not an environmental attorney, not an environmental engineer, not an environmental consultant, not a chemical engineer, not a mechanical engineer, civil engineer, not a regulator. I'm a business person, management consultant, and software developer who's been doing this work going back now for the last 3 jobs. This is the field that I know and I think I'm destined for. So again, I come at this field not from the perspective of science, law, technology, remediation, but from optimization, business improvement, software development, and management consulting. I hope that's a useful distinction for everyone today. With that, let's dive into our topic here, which is fair value measurement. That's the exact precise accounting term, and you can look it up and find it in 3 different sources, more or less in identical layout and format that I've got described here on the slide. The sources of this definition, general accepted accounting principles, come from FASB, the Financial Accounting Standards Board, a little over 10 years ago, the International Accounting Standards Board about 5 years later, and the Government Accounting Standards Board in early 2015. The actual citations are available on the web from those respective GAAP standards developers. You can see those for free anytime you like. So again, I highly recommend taking a read if you have any questions about what the full text reads like and what is out there. They're available for free right now from those respective copyright holders. Well, my summary, my take on what fair value measurement is on the left-hand side of the slide here. It's the preferred method for looking at assets and liabilities. It's based on market inputs, and it looks at, for our purposes today, looking at environmental liabilities. The price of a problem, not the cost of a candidate solution that might or might not work. So again, if there's anything I'll probably drive through today, it'll be we're looking at the pricing for a problem, not the costing out of a solution that might work. It means you're looking at the present value if you're working for a company or a nonprofit, or current value, which is the language in place for doing the calculations if you work for a government agency on the state, county, municipal level here in the U.S. So again, present value in this definition means discounted present value of the future inflation-adjusted cost forecast. So it's technically speaking a present value of a future value versus a current value, which means no inflation, no discounting applied, just 0% inflation, 0% discounting, as though you were going to settle the liability in the current financial period. What does that mean in terms of a weighting? You have an expected value of multiple outcomes. So again, aside from present value or current value, you're also using an expected value to generate a fair value, which means you're looking at things that are maybe out of the ordinary for a budget, things like remedy failure. And you have to start the cleanup process back at the middle or back at the beginning and do some steps over again. It doesn't have a time limit. None of these bits of accounting standards have time limits and say only look out 5 years, 10 years, 20 years, 50 years, and so on. There is no time limit anywhere. It's left to professional judgment. And another topic that's included, and this is by no means an exhaustive list, but counterparty risk is factored in as well, meaning there's some verifiable probability that the people that you're sharing funding with on a cleanup will not make it to the finish line, and you'll have to pick up their stranded share. That's what counterparty risk is. Separate topic for a separate webinar. There are 3 approaches that are listed in each of these GAAP citations in the upper right corner. Those 3 approaches are listed the same way, described with the same words. There's the income method, the market method, and the replacement cost method. Now, I'm going to kick out one here right away. Income method is the impact of income, which means your cash flows, usually defined by your spending plan. This one gets pretty close to what was your budget, what's the cost of a solution. So it's pretty tempting to just say, aha, I'm going to choose the income method and not go through a change in mindset. The next one is a really big change in mindset, which means market pricing. Coming up with a price that would be more or less, in effect, if you had an unrelated third-party pricing mechanism and you had an orderly market where you could reach a mutually agreeable number in a reasonable time. The third, which is problematic, is the replacement cost, the cost to replace the service capacity of an asset. I think this is problematic for what we do, given what little guidance is in GAAP about using this to environmental liabilities. Replacement costs, really, I have I just can't conceptualize how to make that connection between replacing the service capacity of an asset because it means restoring dirt, restoring groundwater, restoring an environmental asset of some kind very far back to its original condition 500 or 5,000 years ago. And that may be just a break on my part. As GAP evolves, we may see better definitions for that are more reasonable to apply. But right now we have just replacement cost, and I don't have a good application example set for all of us today on this. The final point I want to give you about fair value measurement and what it is, it contains a hierarchy of inputs, which means you identify different aspects of your cleanup costs. So you've got one project and you've got different components that you're going to estimate and incorporate together into your liability forecast. You need to put different labels on each part, identifying some parts as level 1, others as level 2, and the remainder you have to leave off as level 3. What are each of those? This will just take a minute to go through, but I provided some examples to help give some frame of reference. These are all mine examples. These are not from generally accepted accounting principles, but the definitions of level 1, level 2, and level 3, they're definitely from generally accepted accounting principles. Number 1, level 1 estimates, which are preferred, means a currently quoted price in an active market for identical liabilities. The examples that I'd like to share with you today are, number 1, we have some excavated soil. It's classified as Class C. If you're in different parts of the country, maybe Class 2 or Class 3 waste. It's going to be trucked to a landfill for a market price that you can get several bids for. So let's say that those bids average out to be $84.50 a ton. That's an example of a current quoted price for an active market. Again, it's not the whole project, but it's usually, if you're doing an excavation project, going to be a significant component of your cost. And that's what you're working on, the component cost level, not the aggregate value of the entire site-specific liability. Next example I've got, we're going to take 500 sediment samples from a wetland area or a riverbed, and we're going to test them for PCBs under an EPA method that's designated as you see on the screen. That we can get several quotes. There's a prescribed method. There's one way to do it right. EPA has set it out over the last generation. So again, that commoditization of that step, 500 samples tested, there's a competitive marketplace. You can get 3 bids for that very readily and have an identical outcome on the back end. You'll have a validated sample result on the back end of that. Next is we're expecting to run a prototype groundwater pump and treat system and use 80,000 kilowatt hours of electricity. Well, for that, you can look up the tariff and call the utility company that has a monopoly for the specific area where the site is and find out what the current market price is on a retail level for 80,000 kilowatt hours of electricity. Again, transparent, visible market, active market, that's what we're looking for, even if it involves a monopoly. But if you can get 3 quotes or you can look up the price on the web, you definitely have the start, a solid start on a level 1 price. Hope that's useful. Level 2 is where you have to do some math, some derivatives, and you get close to a market price, but you're coming into something that's more or less a one-off that's unique to a property. So the way level 2 is defined, it's got some observable inputs, a less active market, and similar liabilities. Arguably, an entire cleanup project can be a level 2 liability without defaulting to level 3 because, again, we've got some observable inputs in everything that we do. So the 3 examples I'd like to share with you here are, number 1, say we've got a site with soils that are 50% gravel, 50% sand. That means if you look it up on the internet, that means a bulking factor. When you pull it out of the ground and it expands as you put it into a truck, it's got a bulking factor of 1.15. Now let's say there's a rule of thumb that we use on our sites that we've got a 20% over excavation of, we have a target volume, and then we're going to excavate 3 feet deeper to make sure we get all of the contamination that we expect is out there. That over excavation will give us in turn all of the math we need to generate a target volume. I know I've left off what the 2D surface area and the depth is, but let's say that those additional factors will take us from a site-specific estimate to what would be a commercial bid price to say what would 130 truck trips cost from point A to point B. Google Maps will tell you the distance. Your vendor will tell you the unit price for fuel and so on. Away you go. Next example are transportation costs that were last estimated when diesel was at $3.65 a gallon, which in benchmark terms was back in July of 2012. federal published statistics that we're working with here that we can then update every year in the space of 5 or 10 minutes. That's the type of example that I refer to and say if it's accessible with a lookup table, the U.S. Department of Labor Producer Price Index, the Energy Information Administration's diesel fuel indices. These are sources here in the U.S. that we use and have available to us for free 24 hours a day as part of the federal statistics publication process that do help us say when we know that our cost at an individual site, the price of an individual component of a liability will be discharged for price X, and it's highly correlated or it's perfectly correlated to some widely disseminated index. Well, then we've got a way to quickly anchor our price to a public domain number, and by tracking the public domain number, we'll get our private domain number all of that much more efficiently and a pretty short turnaround at that. The final point that I want to give you as a level 2 example, we've got a peer potentially responsible party or a PRP that's sharing in our cleanup costs at a site. They have a credit score of 920, and therefore that equates to a 35% probability of default in 10 years. Now, all of that math is something ERCI does to calculate out a short-term credit score into what that means in terms of an expected value of default over 10 years. That's something that we do, so I can tell you firsthand from doing this work for 15 years now, that you can convert a credit score into a reliable probability of default that goes well beyond 30, 60, 90 days that credit scores are typically used for, and you can use that information and update it very, very quickly, quarter after quarter and year after year. Level 3 unobservable inputs are basically everything else. The example that I like to draw you to is there's a regulatory approval of a remediation plan that might take 4 years. Might take 1, might take 5, but it may take about 4 years. During that delay, the groundwater plume may stay where it is depending on rainfall, or it may expand by another 25%. We just don't know. Now, these are modelable uncertainties. These are the types of uncertainties that Monte Carlo tools are built for. But again, you're getting into site-specific variables where there isn't a ready market at all for saying, you know, we're an environmental cleanup vendor, for example. We're here to help you, company XYZ. We will take on your rainfall risk. We will take on your regulator risk that the cleanup will be approved or not approved. Generally speaking, that market isn't fluid, doesn't really exist, and is not cost competitive for every type of environmental liability. So why is this information important? Number one, environmental liabilities are generally settled through spending. And if not spending, then negotiation and transfer to a like-minded commercial enterprise. Therefore, as you go through spending, the temptation, the necessity, is actually to commoditize activities into different baskets. One of those basket methodologies is SIC codes, some of which I've got listed here. Putting spending in means some of the costs that you're looking at are going to be more time and materials oriented. Others are going to be trackable with lookup and update tables that are in the public domain. Different SIC codes have different experiences. And again, if you do this step of breaking spending down into SIC codes, you can see where the trends are with different inflation rates working in effect. However, I just want to step back and say why this is important is probably pivotal around the second point here. Treating an entire liability like a level 3 unique liability creates a little bit of a bubble. It creates an expectation that market prices are not going to factor in, that experience, sufficiency, competition in the marketplace do not matter, and that peer spending on similar sites doesn't have relevancy. I step back and say these are things that get corrected over time. These are things the marketplace and companies and public agencies have ways of fixing. There are checks and balances in place that will have their way with a mindset that everything's a level 3 liability. So I point this out because letting the market tell you what a liability price is instead of letting one monopoly source tell you what a cost might be, it's a healthy step forward. But it's also a necessary step forward because someone is going to do it someday. And ideally, it won't be a look back saying, why did this price come in at triple the cost we initially thought? Why didn't we do something differently? The last point I wanted to share about how important this topic is that commoditization of spending is, if you're working for a Fortune 500 company or a public agency, it's how your core business thrives and survives year after year. By invoking and incorporating economies of scope, doing more with less, economies of scale, applying your learning curve and your purchasing power. If your organization did not do that in its core operating business, it would not be around for long because it would be outcompeted by another enterprise able to adopt those very, very well-known standard tools. So the change in mindset that I want to share with you is, again, stepping away from the situation in the left side of the graph where everything is sort of treated as this homogeneous level 3 unknowable number set, and breaking the component liabilities down into lots of level 1s, lots of level 2s, and then by default, just having a few residual level 3 components. Just to run through an example I've used in other webinars in the past, I just want to give you a sense that you can start with a probable and reasonably estimable number and start with a third-party vendor quote of a cost of a candidate solution that might work, in other words, and you can get to a fair value measurement, but you do have to put in some transitions to walk the number forward. And here what I'm showing on the slide here in this fair value reserve calculation example is how to do that walk forward. And what I'm saying also today explicitly is if you're looking at an environmental liability, environmental remediation liability, and your organization's policy allows it, you can use any of these numbers today as the statement of what your liability is. You can use a low number of just the vendor quote or the fair value as the adjusted number accordingly. Your company policy drives this. Generally accepted accounting principles, generally speaking, just give you the latitude to apply fair value for remediation liabilities. For asset retirement obligations, a different type of environmental liability, there's a very clear, strong express preference in GAAP for using fair value as a basis and not using any other methodology. So, and keep in mind that GAAP gives a lot of professional latitude, a lot of guidance, and a lot of judgment is got to be displayed. What I'm trying to do here today with this slide is to give you a sense of where you can walk a number forward and how and why. So let's start with a vendor quote in the lower left corner of our slide here. Let's say we're going to put in a groundwater pump and treat system. It'll cost $2 million to install and debug, $3 million to run for a long period of time. And we have a 50-50 cost sharing with us and several other entities, and we're all sharing the cost here. It's 50% for us and 50% for the group of them, and that means that our net cost, what we will pay in terms of invoices, is around $2.5 million. That's our starting point, and that we can call a probable and reasonably estimable number as well. Now let's go to the upper left corner. Here we're going to incorporate the factor of remedy failure, that as much as we try and hope, the remedy itself doesn't do the job. The vendor's great, the regulator's understanding, but just the equipment doesn't get the job done and it needs to be expanded. So let's say there's an 80% chance that everything will work out just fine, as designed, as intended, but there's a 20% chance that we need to expand the remedy. We'll need to add more groundwater monitoring wells, add more pumping equipment, more tanks, more water will have to be discharged to a surface water or to groundwater. In turn, that means we've got some math here. We've got 80% chance of a zero incremental cost, 20% chance of a $2 million incremental cost, which means if you do the math on that, an expected value of $400K. Now, there isn't a vendor you can go to today and say, I want to transfer my remedy failure risk. It's something that you have to build into a single contract with an existing vendor, or you have to self-insure, and the latter is, generally speaking, far more likely. Project management is the next cost in the center of the graph. Typically, as a rule of thumb, you may just apply a multiplier like 10% of the costs known are going to be project management of supervising the work, of participating in counterparty tracking, of negotiating with regulators, and so on. That's a reservable cost very explicitly for over 20 years now. That's been a reservable cost. So we'll incorporate that into our estimate because, again, this is the difference between a third-party cost of a vendor quote and our first-party internal costs of managing the liability and having a good accounting system and a good legal system and a good contractual system for spending that money in an auditable way. The last item that we're adding on is counterparty risk. This is something ERCI specializes in, so I'll go a little bit I'll keep it at a very high level for our conversation today. There's a 60% chance of no defaults over the life of the cleanup work, 25% chance of one default that'll add $1 million to our cost, 15% chance of two defaults, which will add $2 million to our cost. We'll leave it just at that for that high level. The math is actually much more nuanced and sophisticated and very time dependent, but the expected value calculation that we'll use today is just that simple. 60% times 0, 25% times $1 million, 15% times $2 million. Add that up, we get an incremental $600K of environmental liability. We sum up all four of those numbers, the vendor quote, remedy failure, the internal first-party costs of project management, and the probability of counterparty default to get our fair value of $3.8 million. When we sum all that up and say, now if our rules say we use probable and reasonably estimable, we're going to come up with a reserve of $2.5 million. If we use fair value measurement, we're going to come up with a reserve of $3.8 million. And at the very bottom of the slide here, I note that you'll just have different footnotes to get to the upper end of the range. Under probable and reasonably estimable, you'll have around $4 million to explain from different sources, and you'll be omitting the idea that you've got project management costs to put into your reserve because you don't ask the question, you don't get the answer. Fair value measurement, in turn, gives you a different basis for getting to that one single number that's toward the middle of the range. If you do a little bit further detail and come up with ranges around each of the components you're adding on, you'll come up with a range around your expected value, your $3.8 million number, and that may vary quite a bit from minus $1 million to plus $2 to $4 million as an increment to get to the upper end of the range. We didn't calculate that, but again, I just want to run through the idea that if you have a policy that says we only do fair value measurement, you're going to generate different numbers calculated in different ways for the very same projects you have in place in your portfolio today. This is a serious decision to adopt fair value measurement, but those decisions apply in different circumstances. One of the things that we're trying to share ideas about or encourage discussions about is the idea that in general accepted accounting principles, ERCI sees 5 different types of environmental liabilities out there. The graphic I've got displayed here cites the different portions of general accepted accounting principles at the very, very bottom of the slide, where we show where the original language defining those types of liabilities comes from. But I want to lay these out because it does give a sense that the methodologies are going to be different from type to type to type. Generally speaking, the largest type of environmental liabilities out there are asset retirement obligations, which are the end of life, end of useful life for an asset, cost to demolish and remove an operating asset from service. If there were no spills, but there's still some contamination, you have an expectation that that's an asset retirement cost. If you do have spills, if you do have incidents or off-site disposal sites that go bankrupt, those are generally speaking environmental remediation obligations, a second type of environmental liability. If you have a contractual commitment between your company and another company about conditions of a lease or buying and selling assets and associated environmental liabilities, that's away from the regulatory framework. Generally speaking, those are contractual commitments, a different type of environmental liability. If you have a circle of past cost reimbursement, you have an outcome from litigation, for example, generally speaking, those are contingencies. Back 40 years ago, 1975, we called all environmental liabilities contingencies. All these other definitions have emerged and improved and been defined and refined just over the last 20 years. So most of what you're seeing here about policies about probable and reasonably estimable is rooted back in the legacy definitions of contingencies that were stated back in FASB 5 in 1975. That possibility of calling an environmental liability contingency still exists. That's still in place today. These other definitions have been added to gaps since then. The last type, off to the far right, guarantees, and these cover things like financial assurance promises like letters of credit, surety bonds, and so on, that give some source of reliance to a regulator that the work that's listed on the other 4 types of liabilities will get funded and executed and be completed to the satisfaction of a regulator. So a guarantee is a financial instrument that has its own relatively modest cost guaranteeing the performance that's over and above the actual costs of doing the work listed under the other categories we've got here. I hope that's constructive, but with that understanding of the different definitions, I want to share with you something I just constructed this month for our comparison of fair value measurement. And I hope, again, I know this is a wordy slide, but I hope this is an instructive basis for identifying how you would use different numbers, different assumptions in calculating your fair value measurement number. First of all, let's start with the purpose of an estimate. When we have an estimate for an environmental liability, we're doing everything listed in the far left column. We're doing everything from generating a reserve forecast to doing cash out insurance claims and due diligence numbers. We have all these different purposes in place. And I want to say in our experience, in practical, tactical terms, you have different time horizons for those different estimate purposes. And in turn, you probably have different inflation and discount assumptions for the very same project. So you may be looking at one project and say, I'm going to generate a due diligence number, and that number is $3 million. I'm going to generate a budget, and that's $1 million. And then I'm going to generate a reserve number, and that's $2 million. And again, you can have the very same inputs, but different inflation, discounting, time horizon, and again, different uses of fair value, expected value, and present value to cover the other columns here in my table. Because you're applying these different principles and tactical elements, you're going to come up with different numbers for the same fact pattern. And I'm telling you right now, that's normal and that's okay. You're going to have a different purpose, which means you're going to generate a different number under different circumstances. This is what Excel is built for, so you've got to use Excel, label your estimate, label your assumptions, ideally put them all in one place at the very, very beginning of your spreadsheet. That's a best practice. But I developed this to give you a sense that if you look at just the fair value column, different estimates use fair value in different ways. And that's something that may not seem intuitive if this is the best way to go. But when you're doing, for example, at the very, very bottom of the slide, a remedial alternatives analysis, EPA has some very specific guidance, and that very specific guidance was not written with fair value measurement in mind. It was written with the expectation of going out 30 years, using 0% inflation, 7% discount rate, whatever the market conditions out there for inflation and discount rate are, but again, just using those factors to compare different cleanup technologies. That's that. That methodology is not going to, however, tell you how to prepare your budget, how to prepare your reserve, how to prepare your due diligence cash out number. And maybe the number everyone remembers when the site is in the press and there's information published about cleanup work, and maybe the one number everyone focuses in on. But again, it's not the only financial outcome for an individual site-specific liability. Next slide here, I've got a quick quiz for you of how one organization, through their public disclosures, went through a transition. I just wanted to just quickly display for you some numbers showing an environmental remediation liability, the red line starting in the upper left and going down to the center of the slide, how it was steadily worked down over the period of 1995 to roughly 2009. And then asset retirement obligations that were not recognized before 2004 were suddenly recognized and have sort of been in the $100 to $300 billion range ever since. But right in 2009, 2010, 2011, there was a giant gap, and then the numbers, as you see, skipped around. The organization split its environmental liabilities at least into two different pools and applied fair value measurement according to their 10K reports. The short version is that's General Motors. That's the story of General Motors and how their environmental liabilities played out in their 10K reports. There's probably a lot of details I'm glossing over because I wasn't involved in this at all. But I do want to point out a couple of things. Number one, back at the end of 2008, the audited, approved 10K report for General Motors said the environmental reserves were $297 million. 4 years later, 3 years later, if you look at you incorporate the audit terms and the audit periods in there, after 3 years, the reserve was 3.2 times that $297 million. In other words, the 297 grew to 940, and maybe even then some. There were still some residual environmental liabilities. So keep in mind, this is my rule of thumb example for saying, if you have probable and reasonably estimable, and you have auditable numbers, the difference can be quite significant. You can have a difference of 3x from your probable and reasonably estimable number versus your fair value measurement number. I know this is just my anecdote, and this is not a perfectly well-researched case study. I'll leave that to be for the PhD candidates of the future. But I just want to show you the daylight between having a reserved, audited, approved number for a going concern at 297, and just showing how quickly that number over a series of months and years and very quickly turn into a number that's quite a bit different. With that, I want to step away a little bit more to another operating situation for a different company. This is the 2016 data from a US-based company that I pulled out of their 2016 10K report, as well as the legacy 10K reports for the previous 20 years. And I just looked at graphing out the environmental remediation reserve, which is the blue and red line at the bottom. And I noted the valuation methods that were in place there. They're using probable and reasonably estimable as their reserve policy. You see the number's basically been in the same place for over 20 years. With the red line from 2016 onward, I'm projecting that number forward and say, what if this company kept spending and adding back to the reserve more or less in the same pattern? Excel makes this too easy to do. I don't know that this is actually what will happen, but just saying statistically and theoretically, if this pattern actually did continue, what would it look like? And that's the blue and red line at the bottom of my graphic here. But then I looked through the 10K report in a little more detail and tried to approximate what would be the alternative valuation of that spending pattern. And here in this example, the organization is spending $84 million a year on average and adding back $101 million to the reserve every year. So spending 84, adding back 101, the average of the last 5 years. What would that pattern, forget what we're reserving for, but what would that pattern be worth if instead that was a pension or a dividend payment or a bond payment? What would that be? And the numbers I came up with quite a bit higher. If these were pension payments measured with pension rules, you'd be looking at a $1.4 billion liability using the same assumptions that the same company publishes in the same 10K report. So again, I'm using the inflation discount and liability accretion scenario that are stated for the pension plan. If dividends were paid out, that would add $1.9 billion to the market capitalization of the company. And if bonds were issued, you could pay interest on $2.5 billion of bonds for that $84 million a year. So my point in bringing all these examples up is, if you're looking at the fair value at the market price and say, what is the market price of spending $84 million a year in the abstract, forget what it's for, but what's that pattern of spending worth in the marketplace? That gets you right to fair value measurement, because then you stop saying, well, I won't be able to spend that money this year. I don't know what the remedy is for that site. The regulator doesn't even have a plan for how we're going to fix these other 20 problems. You step out of that and say, forget, you're equipped to spend $84 million a year. Start with that. What's that pattern of spending worth in the marketplace today? And you come up with these numbers that are very, very far away from $0.5 billion. And that's the essence of my point, is the spending pattern, which I'm sure is reasonable and competent and very wisely spent. This is a company that I'm competing against and respected as a manufacturer. Really, I look up to the people that work at this company, because they're some of the very best in their industry. They're doing the best they can. You start with a trust and an expectation that they're doing the best they can. But then you step away and say, in today's low interest environment, what's that $84 million of spending worth? And say, no one would, at an arm's length, say the level one valuation of that $84 million a year is it's definitely $500 million. But I'll take that problem on myself. No marketplace exists for that. And the point of the marketplace that I want to give you is that the marketplace is a fluid, living, moving thing, because it's an embodiment of all of the different economic activity going on today. So let's transition to a different industry and look at oil and gas for a second, or actually just the price of oil. Back in 2014, the price of oil was around $100 to $110 a barrel, and then in the space of 6 months, dropped in half. And it stayed roughly there. It's actually gotten a little worse and gotten a little better, but it's basically been stuck at that $50 level on average since then for about a year and a half, 2 years now. In that time, someone looking at the ownership of their oil well can say, well, at $100 a barrel, that asset was worth $5 million based on the income that it was throwing off. And the remediation liability or the asset retirement obligation to plug and abandon the well at the very, very end of useful life was only half a million dollars, because we can't imagine the day when we'd shut this profitable operating asset down. Fast forward to the operating income is cut in half for this asset. You say the fair value may be far less than half of what it was just recently, and the fair value of the asset retirement will probably change significantly, probably by a factor of 5 or 10, because of a couple simple reasons that I've got listed in the lower right corner. You're going from a world where you had an unknown data settlement, unknown future cleanup levels, unknown future source material, to now knowing that there's a strong chance you're going to have to immediately settle that liability based on current cleanup regs and based on today's source knowledge of any spills that have occurred. And that's what you're going to have to run with. So that switch can happen that fast in the space of 6 months. And it did for some companies, and it did send them into Chapter 11 reorganization in the upstream oil and gas exploration business. So a couple of frequently asked questions that we receive at ERCI on looking at fair value measurement. I got the statements on the left and ERCI's canned replies on the right side. But just in talking about fair value measurement for the last 10 years or so, here are the FAQs that we've come up with. Number one, fair value applies to valuing our assets, like our pension plan investments. So yes, that's what it was initially designed for, but it very, very clearly applies to assets and liabilities. It's not just a valuation of the commercial paper at a bank, although that's where it had dramatic effect, was in revaluing the assets of financial institutions going into the big recession, 2007, 2008. Fair value measurement had a huge impact. It was an accounting change, and it was derisively called mark to make believe instead of mark to market. But fair value measurement does apply to assets and liabilities. Next, our reserve policy generally calls remediation liabilities contingencies. In other words, we use probable and reasonably estimable as our filter, which is fine. That's all fine. That's all completely fine. However, it's not mandatory that you use probable and reasonably estimable. Fair value measurement applies to, and as I noted in the previous couple of slides, if you hold on tight to probable and reasonably estimable, you might be in the seesaw pattern of just going back and forth with the number and just continually adding back to the reserve balance. Ideally, you would adopt fair value measurement because it gives a more accurate story of what the liability is and what the value of those cash flows are and will be. Next statement that I hear quite often: our environmental reserves pass audit every year. As one fellow in New Jersey prosaically put it, you have a solution that's in search of a problem. So fair value measurement is again, it's out there as part of general accepted accounting principles. It does not add value in every single situation. But what's been identified there of your passing audit, your CPA is good with the numbers that you generate, you're probable and reasonably estimable. It's a very, very common outcome. But if you step back and say, well, now what have been the root causes of recent reserve increases? And if the answer is it's because we bottlenecked information instead of letting that flow down to our calculations of our reserve, then the issue is with the policy and with the methodology. It's not with the people or the vendors doing the work or the management that's reporting these results. It goes back to tools and processes and not people and mindset. So again, if you did a root cause analysis, I don't think you'd find you learned anything over the last few years to justify your most recent reserve increases. You simply have different triggering mechanisms for adjusting your calculations, all of which can be audit compliant, but still can get you into a situation of misallocating capital. And I'd say that's actually the outcome you can't talk me through, that you're allocating capital better because you passed. At any rate, next point, auditors never ask for this. Our reserves are immaterial. That's all, again, perfectly fine. But if you're making a statement that says everything we've got booked here is at or near market value, which happens during transactions like mergers, acquisitions, divestitures, spin-offs, that's when having a market number is different from having a reserve number that's probable and reasonably estimable. So to do that, you need evidence. And if you put your name on a statement that says this reserve is a market price, you've treaded into some difficult territory here. Last point, some answers are privileged, some answers are confidential. And I nod my head yes, that's entirely normal. Compartmentalization of information is entirely useful, meaningful, and appropriate. I just say that that's an ongoing discussion over my pay grade regarding how to balance business needs with attorney-client privilege. With that, let me give some observations on fair value measurement before we get into how to adopt it. First, if you're doing a divestiture, if you're spinning off an asset to a buyer, due diligence can uncover some unpleasant surprises if you've not adopted fair value measurement, because you will find them in reaching that market price. That's what due diligence does. It invokes fair value measurement. So again, if you've been buried in a different method of estimating a liability, in other words, you've been using cost-based approaches, you will now get into a price-based approach very, very fast through due diligence. In acquisitions, the normal procedure spelled out in general accepted accounting principles is that if you take a discount for an environmental liability, you should be reserving that at the close of the transaction and then very quickly reevaluating in the first 2 years of ownership, ideally the first year of ownership, just what you bought. That's going on for the intellectual property your company acquired, for the buildings and real estate and ongoing patents and a whole variety of other assets. That's going on. Environmental liabilities needs the same sort of mark-to-market process. That means you may decide through due diligence that there's $1 million discount to take on this liability, and then you may find out more facts that say it's actually not $1.1 million, it's actually $1.5 million. That's a purchase. That last $500,000 is a purchase accounting adjustment that goes on top of the acquisition initial valuation. Don't lose the chance to take that purchase accounting window, is my point. Another observation that I want to share with you is that reserve might not be a current market value of the liability. We showed in a few case studies previously in this presentation. The root cause that I hear are things like, we don't know what accounting does to our numbers. We think the multi-year budget is roughly our reserve, and then roughly our reserve is our liability. Those are thought patterns, those are behaviors that can be unlearned and be corrected. But one outcome that I really have trouble with is I can't explain the number that's in our 10K report. That's not a good outcome. That's not good capital stewardship. So I want to say fair value measurement is a path through the forest of understanding what's in a 10K, what's a liability versus what's a reserve, and then understanding how accounting is processing your numbers. Often I find that a company's internal reserve policy, how GAAP is interpreted, is part of is one of the key tools in the toolbox, as well as auditors. So again, if there isn't an updated revised reserve policy, which is not unusual, and if auditors are not concerned, not unusual, adopting fair value measurement may not come up. But proactively, to transition to fair value measurement, I think you'll find you come up with a whole series of good benefits that come out of this. Number one, you'll come up with data that's useful to decisions about capital allocation and useful to decision makers. Having fair value data handy eliminates surprises. Next, it's GAAP compliant. It's a relevant and faithful representation, which are part of the principles that we're after in general accepted accounting principles. And in other ways, other attributes that we're going for, the data is comparable, verifiable, timely, understandable. We're trying to meet these gold standard adjectives here, and again, fair value measurement enables us to take vague, blurry, tough to understand environmental liabilities and move closer to having high consequence valuations. Next, we get to focus our spending on a liability reduction and not simply other steps like deferral or remedy selection. I know those are fun, those are interesting, those are attractive ways to invest time and effort, but again, your spending from the shareholder's perspective or stakeholder's perspective is supposed to be on liability reduction. And if you're communicating liability reduction in exchange for spending, great, you're doing a good job. If you're exchanging spending for running in place, just showing that the liability is stubborn and stuck there, I think you may be missing a chance to explain a good part of the story about what's occurring behind the scenes. Also, I think another benefit of adopting fair value measurement is because you're documenting a whole variety of issues that are in watch lists or in Monte Carlo models or decision trees. You're helping with knowledge loss. Instead of having details that are just in the head of a project manager, just in the head of an attorney, just in the head of an outside vendor. You're consolidating that information and showing what your current expectations of outcomes look like. Finally, I think that fair value measurement improves execution on acquisitions and divestitures. It's good capital stewardship. Nothing is perfect, but it improves from a middling job to an above average job. And finally, you can identify portions of your portfolio that have exposure to not getting recoveries, cost recoveries with your counterparties and insurance carriers. So how to do this? A couple quick steps about how to do this. I'll really be buzzing through these. So again, slow the presentation down if you'd like to take this up in more detail. But overall, you want to figure out if fair value measurement is a good business fit for your organization, because you're trying to figure out how to comply with that duty to display your environmental liabilities, your obligations to management, and possibly to figure out what you're going to disclose. So I'd recommend, first and foremost, there's a pivotal step of getting there, which means adopting a pilot project, getting consensus for not, we're going to jump in with both feet and the net will appear. Don't do that. Start with a pilot project. Conduct that pilot project on a single division or plant or asset type. In other words, less than 25% of your environmental liabilities. Don't try and look at everything all at once. Make it a 90-day effort. Use a fair value measurement term sheet template, which I've got displayed in another few slides. It will force you to look at some numerical valuations. It'll bring a different level of discipline, and I promise you, you will get a scorecard together of what's a level 1, level 2, and a level 3 estimate on a component level. That's the major thinking that you're going to be doing in attempting a pilot fair value measurement evaluation. From there, after you've done your fair value measurement evaluation, you want to step aside and do a retest of, you're going to do this sort of evaluation rather to identify what were the component costs. And here in the center 2 slides, I want to point out what new information you'll generate or what repackaging of existing details you'll find from this evaluation. Number 1, for example, in row A, the life cycle cost projection. Instead of expressing the technical data as it's currently expressed, you'll find a middling ground of how to convert the technical data into terms that the business can absorb. So you'll say things like, everyone expects there to be 12 years of pump and treat at this site, and it'll be 10 gallons per minute from 5 wells. We'll pump out that entire aquifer 3 times over across a 19-acre area. I've opened up many environmental reports. I've never seen that simple statement of, here's what we're going to do. Here's what the problem is. Here's what we're going to try to use to fix it. That in turn means you've got, just with those simple statements, which again, I think most any environmental consultant can generate very quickly if they're asked. They can generate this quickly. They'll give you, again, a fair value measurement, at least a level 2, if not a level 1 set of numbers right there. The next line item down gets to be where the little of the tough thinking comes into play, but you'll have an expression like the following. You'll have a 25% cost increase for pulling out the aquifer one more time, pulling out a 4th pour volume, doubling the well count from 5 to 10 in years 8 to 12, and that'll cost an incremental cost. That'll incur an incremental cost of X. Again, those are the differences between saying, here's the problem, here's the isoplex of the pollution, here's the mix of different contaminants in the shallow aquifer versus the deeper parts of the aquifer. It distills down, again, the problem into components that can be either costed out or priced out, because that's what you're after. Cost that out gives you a level 3 number. Priced out gives you a level 1 or level 2 number. I'll spare you the rest of the term sheet here because it's, again, far more interesting to work it out on a real site. But the very idea that you're going to be reconstructing a reserve, but you're going to be asking different questions to get the different answers of what the fair value measurement is, means you're going to be learning a lot in adopting fair value measurement. And you're probably going to be figuring out along the way what policies need to fix, what need to adjust rather, what training needs to be done to help individuals stop using old methods and start using different methods, and how in turn that'll affect budgeting and capital stewardship. After you do your pilot evaluation, you're going to do a post-pilot look back and make some conclusions about what resources will be needed to adopt fair value across the whole portfolio. Then you should stop, pivot, ask everyone who is a stakeholder in this effort if they endorse the final decision to move to fair value measurement. You'll be happy you did later, but you shouldn't dive in and say, we're going to do this and then we're going to ask for forgiveness after we've adopted. Changing accounting policies has lots of stakeholders. It's not complicated, it's not rocket science, but it does involve using the politics and the relationships in your organization to good effect to say, we used to have this pattern of behavior. The environmental reserve sort of went sideways, and it never went up and never went down. We want to move to fair value measurement, so if we bought or sold the entire business tomorrow, we had a reliable market number that's in place today, and that reliable number might be 20% higher, it might be 300% higher, or it might be 10% lower than the number we use today. So again, get buy-in for that, because again, you're going to be trying to change the jobs of a lot of people all at once. Tiny bit, but you're going to be affecting a lot of people, and having that buy-in is important. The steps that I've got listed here really tell you how to get from there to there. You want to develop the business case, confirm the cost benefit for the information you're generating, determine the governance and frequency of how deeply you dive into that. I recommend doing deep dives on sites every 2 to 5 years, depending on different circumstances. And then you want to implement and refine as you go forward your transition plan. Do not try and do fair value measurement revisits on every site every year. It's not that fluid an environment in looking at every aspect of every environmental liability every year. It doesn't pay off. Looking at them every 3 to 5 years, though, is probably wise. That gives time for new remedies, new technologies, counterparty risk, remedy failure. It gives time for details to set in. If you're looking at a watch kettle, it'll never boil, right? So the same sort of story here. Environmental liabilities, my experience, nothing in gap to go on, just my experience, is that looking at the portfolio on a 3 to 5 year cycle is probably eminently practical. Next, I think it's incredibly useful to go at the center of the slide here, to rebuild forecasts after major transactions like acquisitions, divestitures, and spinoffs. You have a modest amount of time to do that and an important duty to redo it. Confirming the type and approach for each liability, whether a liability is an obligation or a commitment or a contingency, involves thinking, it involves buy-in, it involves collaboration between people with a lot of different perspectives on what the issues are and what the prospective solutions are like. In turn, that instructs you how to use the different types of money that are available to your organization. Tax consequences, inflation, discounting, budgeting. ARO money is not OPEX money, which is not CAPEX money and not reserve dollars. You have at least 4 types of money, 5 if you include other people's money. But you have lots of different types of money available to discharge environmental liabilities. Using them wisely is an important part of optimizing this activity. Finally, it's important to, again, restate and rebuild exit strategies for your environmental liability portfolio. You may want to work down your environmental portfolio. You may want to simply fund it and isolate it like your organization may do with workman's comp claims or some other similar type of predictable liability. I don't know, and I don't have skin in the game. I'm just saying your organization will probably have an interest in doing one or the other, of resolving the liability aggressively or simply moving it to a different type of enterprise and observing it more closely. So the best practices that we see in adopting fair value measurement are training everyone. Training. There's no substitute for letting people know what's in the accounting principles, what latitude of professional judgment is there, and how to apply it. We think term sheets are the great expression for applying what everyone's learned, and keeping those updated is, again, pivotal. And those term sheets, again, will build into something called watch lists. If you want details on watch lists, I recommend my other webinars on recognizing and measuring environmental liabilities and presenting and disclosing environmental liabilities, and the ASTM standards E2137 and E2173. We've got examples of watch lists in those documents. Keep in mind that you're going to continually learn more and continually find out what factors go into your valuation. The simpler expression of all of this will come into this type of presentation that's in place in 10K reports today. I've seen many of these tables in place because they're a best practice. They're a lesson learned about how to display level 1, level 2, level 3 liabilities. You may be stepping back and saying, asking how does this apply to the work that I'm doing? And the short version is you want to be able to do two good things in managing environmental liabilities. They're sort of behind the scenes. The number one thing that you want to be doing is showing that there are less and less dollars stuck in the level 3 category, that you're gradually working down your estimates that are just stuck in there. You may have level 1 numbers growing, level 2 numbers growing, but working down the level 3 numbers and saying we didn't have a way of seeing ourselves out of a site-specific, unique valuation of a liability. Just showing that you're making progress on that over a series of years is a really good idea. Why? It reconnects your liability valuation to the marketplace. It gets you out of looking at every liability like a unique outcome, and it gets you into the position of commoditizing services and what you're buying. And that commoditization lets you, again, figure out how to do more with less and get your economies of scope and economies of scale firmly in place. The next thing to work on is metric number 2. Keep working on the share, not just the absolute dollar, but the relative share of estimates that are in level 3. Ideally, you'd like to be showing those dropping pretty quickly too. If you don't measure it, you don't manage it. So again, part of the job is if you do your term sheets, you'll have a starting point, and those starting points, again, year after year, you can work on. Again, keep in mind our examples from a couple slides back when we looked at one company's numbers and how they were spending $84 million a year and adding back $101 million every year. I want to just give you this sense of if you have a likely number, you call that number your likely environmental liability, you still have these backup definitions expressed in general accepted accounting principles of a reasonably possible environmental liability and a remote environmental liability. But again, what's in 10K reports today is that likely number, that reserve number. But if you're showing progress, that's better, more useful, more meaningful, more consequential. You're showing the top end number is going away, it's pancaking down. That's a different result than showing your reserve just running in place and staying stable. And again, if the numbers tell us anything, it's that there may be more than what we're just working with in terms of reserve balance. So just to wrap up our discussion here today on fair value measurement, what's at risk for doing fair value measurement properly is if you don't do it, you run the risk of misallocating capital, which means misallocating your people, their time, your money, your reputation, and your attention that might be better spent on other things. And you're also at risk for not complying with general accepted accounting principles. It's not good to go through a restatement. It's not good to have your numbers be contradicted by others that have invested a reasonable amount of time and a different philosophical approach to come up with a more defensible and reliable number. So what can improve? What can you fix? Figure out if there's a big gap between your book value and your fair value, as we saw in the previous slide. And if there is, figure out what you can do about it. Next, will cost recoveries be capturing your full life cycle costs, or will you be leaving money on the table? Again, a good idea to remember that net exposure is an important part of your calculations, and fair value measurement can help you figure out and anticipate if your counterparty risk exposure is a key part of your valuation of your liabilities. Next, does your spending match or highly correlate to your liability reductions? If your organization is ready to spend money, which most definitely are, but you're not getting liability reductions, a stakeholder's got a reasonable set of grounds to ask, what are you doing with the money if it's not to work down the liabilities? Tough questions that have happened in pensions, post-retiree medical, other contingencies that we measured back in 1975 in the same way. They've had different rules applied, and we've got different accounting outcomes now where we expect spending to reduce pension liabilities 1-to-1. And if it doesn't, then we dig a lot deeper. Environmental liabilities deserve the same sort of judgment and treatment. Spending should highly correlate to liability reductions. If we don't measure it, we haven't got a chance of managing it. Next, are we discharging booked liabilities at a reasonable rate? Are the liabilities running away from us and just growing too fast? We'll never get a handle on it. Or are we trying to spend too aggressively and we don't have any hope of resolving all the liabilities in 2 to 5 years? What is the right balance? What is the right pace to closure for the whole portfolio, aside from individual sites? There's some fine-tuning there. Evidence helps enormously. And finally, what we can improve is looking at our ARO forecast, our asset return obligation forecast, and figuring out if they're reasonable and appropriate relative to the size of the asset base that we've got in place. Just to wrap up, thank you for joining our webinar today. Our website is at erci.com. If you'd like to find other recordings of this webinar, we have a YouTube page set up for just storing the current versions. We take off our legacy versions from previous years periodically and replace them with updated versions. If you've got questions about this content, feel free to send me an email or give me a phone call anytime. I'm on the west coast of the U.S., so 7 a.m. to 7 p.m. is fair game. And if you'd like a copy of the presentation, again, feel free to drop me an email anytime. Our other webinars in this cycle are calculating environmental liabilities, calculating and managing environmental counterparty risk, and presenting and disclosing environmental liabilities. With that, thanks for joining us for this webinar.